Welcome back to JPMorgan Chase News. This week we're focusing in on tariffs, what they are, the impact they could have on consumers, and how investors can navigate the uncertainty surrounding them. To give us insight and a better understanding, we're joined by the head of U.S. investment strategy for JPMorgan Private Bank, Jake Manoukian. Welcome.
Thanks for having me.
Can you start off by explaining what tariffs are and the role they play in the economy?
Yeah, it's good to start at the beginning. Tariffs are just a way for a government to raise revenue. And the way that they do that is they tax imported goods and services that come into a country. And tariffs have been around for centuries or millennia. I mean, in the Roman Empire charged tariffs, the Ottoman Empire charged tariffs, and in kind of medieval France and England, tariffs were a material source of revenue. Even in the United States, before corporate and individual taxes, tariffs were a primary source of revenue for the federal government. The other reason why governments like to use tariffs is it can protect a domestic industry. So if there's an industry that is deemed important by the government and they want to kind of insulate from external risks, the government can put a tariff in place so that it stymies competition from abroad. Now, the reason why tariffs came out of favor is because thinking from economists like Adam Smith said, hey, free trade is probably way more efficient because countries can specialize in the production of different goods and services. And everyone is better off if everyone does what they're good at and then has free trade to kind of fill in the gaps where they don't need them. So the global economy has kind of moved in this direction, especially after the end of World War II, towards more trade integration and lower tariffs.
And if tariffs are imposed, how could this impact consumers and influence the way they spend?
It's a great question, and it comes down to who pays the tariff. Now, literally, the company or the entity that's importing the good is going to end up paying the tariff, but they don't want to eat that in their margin, right? So they're going to pass on those price increases most likely to consumers. So the effect that we would likely see for consumers is higher prices on those goods that do have a tariff in place, unless there's a substitute that's manufactured domestically or from a country that doesn't have a tariff in place that they can then pivot to. There are some good economic studies that suggest that if 25% tariffs on Canadian and Mexican imports go into place along with additional imports on Chinese goods, it could cost the median household something like $1,200 a year. But those estimates are up to a lot of chance in terms of how quickly manufacturers could kind of reshift their supply chains and how willing consumers are to pivot what goods they actually buy.
And you just mentioned the supply chain. So how could this impact the global supply chain? Are there certain products, too, that might be impacted more than others?
Yeah, there are. And the interesting thing is we have an example of this from the kind of 2018 trade war. Those tariffs ended up being imposed on imports from China. And what companies ended up doing is they shifted their supply chains. And actually the big, quote unquote, winners from the trade war with China were places like Vietnam and Mexico. U.S. imports from Mexico went up by over $150 billion, for example, after the imposition of Chinese tariffs in 2018. So that's one way that kind of companies and consumers in the global economy can pivot to avoid these tariffs. In terms of the specific goods, it's the goods that have the most complex supply chains in terms of various locations. So we're thinking about things like the automobile industry, the electronics industry, semiconductors, cell phones. All of those goods are built and have components sourced from many different jurisdictions. So raising barriers to trade and raising tariffs would impact those supply chains the most.
And lastly, what should investors keep in mind when it comes to navigating this uncertainty?
Yeah, potentially the biggest risk might be the uncertainty. And that's really been an overhang for the market. If we had a resolution to this and we had a final announcement on the tariff policy coming from the administration, the market might even breathe a sigh of relief. For long-term investors, I think they need to realize that sticking with their asset allocation that's aligned with their goals is probably going to be the best way to shield against potential volatility that tariff announcements might catalyze. The risk that we're watching is that tariffs lead to greater inflationary pressures. And the market is still very sensitive to potentially higher inflation. If companies are passing on tariff increases to consumers in the form of higher prices, that could lead to more inflationary pressures, which could lead to further potential volatility. For long-term investors, what they should focus on is adding assets to portfolios that have inherent inflation protection properties. So for us, that means things like real estate, infrastructure, potentially gold, potentially things like equity-linked structured notes, potentially things like hedge funds for qualified investors. But we're really just focused on making sure portfolios are resilient against those potential risks that might arise.
Jake Manoukian, the head of U.S. investment strategy for JPMorgan Private Bank, thank you so much for that great insight and for being here today.
Thank you for having me.